Welcome to Acumen Analysis, the show where we discuss the economic, market and political decisions that are impacting you and your business.
Welcome to Acumen Analysis Series 3, where we are joined by Dylan Falvey, who is a commercial consultant, and we're going to be talking about a whole number of things across many episodes, mostly what people get wrong, and mostly how we can help.
Yeah, thanks for having me.
Welcome, Dylan. Do you want to introduce yourself quickly?
Yeah, so Dylan Falvey, I run a business called SRG Strategy. We are a consultancy and a family office, so we help business owners and entrepreneurs and established businesses put institutional grade operations strategy into their businesses so that they can scale, raise capital, make acquisitions, exit at a good value. So it's anything to do with businesses that want to grow effectively. So we've seen it all when it comes to business owners making mistakes, business owners not getting the funding they need, and have a lot of great stories to share today.
Awesome. Welcome.
So Edmund, tell me, when it comes to business growth and structuring your company as an entrepreneur in the UK, one of the hot topics today, thanks to Rachel Reeves and the Labour government, is your money basically disappearing as you make it. So I'm wondering what advice you have for business owners right now who are sitting on businesses of some value, whether not a lot of significant, and are worried about their dollars. Everyone's moving to Dubai. What can they actually do?
Yeah, there's lots to unpick. You've just mentioned a whole bunch of stuff. I mean, there's structuring when you first start. There's structuring once you've already got something established. And I think you need to take those as two separate points. But structuring when you first start really depends on how much money you've got to throw at it. As it does with structuring when you've got something a bit more well established. You know, the bigger you are, the more you can spend on these sort of convoluted structures that the likes of Amazon and Starbucks put in place. But you really have to be earning X amount plus for it to be worthwhile, because those sorts of jurisdictions which help support those kind of structures are very expensive to operate out of. I mean, it's essentially the only thing that makes up their economy often, you know, whether we're talking about Cayman, BVI, Jersey, Guernsey, Isle of Man, Dubai, you know, except for financial services and all that stuff, you know, they might have a bit of tourism, but that's largely it. So when you're coming to starting up a new venture from the off, I would say you definitely want to get the right people around you. There's people who've been there, done that, got the T-shirt 100 times before, and they've seen it go wrong, and they know what not to do, which is almost as important as what to do. But whether you structure yourself in the UK or overseas, I would say is really highly dependent on what you're trying to achieve and what your sort of international goals are as well. We know that the world is becoming a smaller marketplace over time. It feels like, you know, my clients are trading with the US and Australia and Europe and the Middle East as a standard thing now, where maybe 20 years ago that might have been not normal,
It's more rare, yeah,
or really rare. So all those sort of transactions abroad have an implication with what you're trying to achieve as well. You know, you want to think about sales tax as well as corporate tax, as well as what do you do when you sell the business, you know, capital gains tax, and if you should pass, you know, are you of an age where you need to think about that as well? All these are sort of considerations that come in structuring more generally. I think once you've got something really established, there's an exercise then to relook at what you've done as well.
When is that point? So like we have a few mutual clients. If somebody is doing over $1 million in revenue, they're making, let's call it 100,000 EBITDA. They paid themselves quite handsomely that year. They're not growing much bigger than that. Is it worth doing an offshore structure for that business, assuming they're going to sell it one day?
Yeah. So whether or not they can do some sort of restructuring thing with an element of offshore really depends on the commercials. There needs to be a good justification for doing it. But at that sort of size, I would say it probably isn't worth it at that size unless they were going to see tremendous growth. In the UK, it's really cheap to incorporate a business. I mean, you can do it online, 25 quid, off-the-shelf company, right? If you're talking about somewhere like Jersey, somewhere like, you know, the
Isle of Man,
Caribbean,
Jersey, Guernsey, the classic ones that are
all the
close to
above,
home, right?
You could be easily incorporating for like 10K. And that's, you know, depending on your size, that's either a lot of money or it's nothing. For 100K EBITDA, that's actually quite a chunk. You know, it's 10% of your EBITDA. It's probably going to feel like a pinch to do that. And it really just depends whether it's worth it and whether the commercials will stack up as well.
Yeah, but I guess what we're up against is people don't understand that. So what we're up against is everyone is seeing on social media people moving to Dubai. Dubai is supposedly tax-free. It's not anymore for income tax anyways. It's not going to be long run for capital gains and those things, right?
Yeah.
If you look at how Singapore and all these other countries have welcomed everybody in, and then basically once they're in, by the way, we're going to
hike up the tax.
Yeah. So if I'm sat here and I'm like, right, all my mates are going to Dubai, they're saving taxes, is there a way that I'd have to leave the UK?
Yeah, so you've touched on two things. Yeah, there's definitely moving to the Dubai, regardless of where your structure is, obviously changes your tax residency if you're doing it permanently, and therefore you fall under, UAE tax rules. Similar if you were to just move to Cayman permanently or move to Hong Kong permanently, you change your tax residency, and then the money you receive into your own pocket is taxed based on that jurisdiction. With the corporate structure, you obviously pay tax based on each entity in the group, pays tax based on whether over the tax residency. What a lot of people don't realize is that companies actually don't pay tax based on where they're incorporated. They actually pay tax based on where they are operating out of, where the decisions are made. So I actually had a call with someone earlier today who set up a BVI company a couple of years ago, only really started trading in the last couple of months. But having had a chat with her, she realized that actually she's the only person making decisions. She's the only one who's running that company. She hasn't actually done any sort of thinking about having a director over in BVI, for example, making the core decisions or having board meetings over there. So actually, for tax purposes, that BVI company is a UK company. She was very disappointed to hear that. Her face kind of went.
Yeah, you would have thought that you'd have to have director requirements out there, form of headcount or representative. Like I know the Cayman does, as an example, you have to have a local director and an accountant, even though that's a bit of a facade. You need that as a condition or a criteria.
Well, some of these jurisdictions will require like a local director, and others just don't care where the director is because it's sort of not their problem.
Yeah.
In this particular scenario, she's ended up being able to set one up overseas, thinking she was going to get all these amazing tax benefits, but in reality, HMRC has their hands all over her, really, and it's a shame for her. But if she's got the right advice, she would have sort of avoided that. You were talking about living in the UK, but getting some of the benefits of having a sort of overseas structures and stuff. That really just depends on the commercials. There needs to be a commercial rationale for this thing, unless you're setting up a business from scratch, in which case I would heavily consider getting an advisor who's experienced in setting up international businesses and having a chat about which jurisdiction is best, because you could have a trading business out of Dubai or out of Jersey or Isle of Man, wherever it is, and be living here and really only paying tax on the income you receive from that business, as long as all the decisions are being made in the right jurisdiction.
So the two things separate. You've got your personal residency, you've got where the business jurisdiction is.
Yeah.
But let's run through both scenarios. So let's say that we set a business up 10 years ago. It's now highly successful. It's based in Manchester. We live in London, right?
Yeah.
Hypothetically. We go to an expert advisor and go, look, the business is worth about £15 million. We're looking at selling it. We're worried about our personal tax. Scenario one, what is the typical go-to mechanism in that?
I mean, look, straight off the bat, there's some reliefs in the UK for selling a business in the UK. It used to be called Entrepreneurs Relief. It's now called Business Asset Disposal Relief. It's 14% tax on up to £1 million per shareholders. Assuming you qualify, that's not terrible in the grand scheme of things compared to other taxes you pay in the UK. If you've already found a buyer and you're thinking, I want to move quickly on this, there's probably not a lot you can do. Mm-hmm. You're probably stuffed, actually. You're probably stuck with whatever reliefs are there at the time. I mean, I assume Rachel Reeves is going to pull that imminently. Tax raids on the next one will be just worse than it was before, unless we get a re-election anytime soon. Better not put any of our political views across, just in case. But if you've got many years to think about, what the structure needs to look like, there's sometimes things you can look at. We're working with a couple of businesses that actually are looking to expand internationally anyway, and they're thinking about selling in the next 5 years. And in those scenarios, they've actually got a commercial justification for spreading out from a structure perspective. And there's actually a lot more we can do there. But still, you're still subject to potentially being criticised by HMRC, and if you're really careful about what you do, you can't just go setting up structures willy-nilly and think you've got it sorted. It's really, you have to get advice. It's become a real minefield in this space.
Yeah, but let's assume that this person wants to stay in the UK, his family in the UK, so they're not willing to move themselves. Besides the reliefs that you mentioned, how can an offshore structure of a business or a trust shield them from the capital gains tax when they sell a business?
Well, assuming that they're able to move from one to the other, because the problem is advisors have to try and, weigh up a lot of different taxes. When you're transferring your structure that you've currently got underneath something else, you need to think, are you making a disposal? Are you creating a capital gains tax event right there and then? Is there stamp duty to be paid by the person taking on the shares? Is there potentially an exit tax out of a group? There's loads of things to think about. But assuming your advisor can get you from A to B, you could be saving loads of money. You could be saving potentially capital gains tax on the sale of the actual group. If you were to pass before that happens and you've got the sort of value of the business under a trust structure that's, with a settle or has been off overseas or whatever, potentially you save loads on inheritance tax as well. But it's very much case by case.
Yeah. So it's a tough one because it's very expensive to do at the start. And then once you're big, it's complicated and could be expensive to shift over.
It's always easy to do it right at the beginning, but like you say, it's expensive and it's often when you've got the least amount of money.
Interesting. Okay. Yeah, because a lot of people don't have their tax structures optimized. And if you think about how the average small, medium-sized business in the UK started, they make a bit of money, they normally get a local accountant eventually. That local accountant is probably outgrown at some point. They've had the wrong advice. They may have wrong filings. They certainly don't have any of the right pension, etc., in place. You can only do so much backdating. So maybe if we talk a bit about common mistakes that you've seen people make with regards to that when you've been onboarding clients.
Yeah, so I've onboarded loads of clients. I'm one of the sort of main people that, triages that. And I've seen countless mega errors in structuring. One that I can think of recently was had a Australian client who'd actually moved to Dubai, as it happens. And I'm trying to remember the product they were selling. It was something like, make your nails at home kit for probably women, I think, but I don't want to make any assumptions. And it was basically taking off in Australia. They were making loads of money and they thought, let's go to similar markets. So they launched into the UK, he set up this company, but unfortunately he set up this company firstly in his own name, as in it wasn't part of the group. And so he was losing out on a few benefits there. But second of all, he actually put an enormous amount of share capital in there, which he then owed personally to the group. So he either needed to pay that money into the business.
You mean to capitalize the business?
Yeah. So rather than doing like £1, one share for £1 or something, he did something like £30 million worth of shares. And he had this immediate issue where he had a potential S455 tax problem. So for those of you who don't know, if you've got an outstanding loan, so you owe money back to your own business as a director, you have this, it's to stop disguised remuneration. HMRC put this thing in place to say, look, if you're just taking out loans all the time and you never pay anything back, it's basically a dividend. We're going to put this thing in place where the company gets charged, I think it's 37.5%. I forget, it might be a bit less. And it's a temporary tax. And as soon as that loan gets paid back down, you get the money back into the company. And it's just to stop people from having a, disguised remuneration. Anyway, he had this problem. So we had to completely restructure the whole thing. It cost him like 10 times more because he'd messed up.
Yeah.
He had to do a whole bunch of stuff to just, fix it. We see that all the time. And it's people doing stuff on the cheap. I often say, go cheap, pay twice sort of thing. It's
massively. In most things, I mean, if we even take like construction as a sector, a lot of people are pushed for price there. Yeah. And, it's a classic, I can do your conservatory for 10 grand. The proper service provider might be 25. You go with the 10 grand thing, then you're having to spend another 25 grand on top of that to get it done properly.
At least.
I've seen it happen. I mean, you've just had your house done, right? So it's one of those painstaking things that unfortunately a lot of people don't learn. And they sometimes have to learn the hard way.
Yeah, and it's unfortunate if you're in the position where you don't even have the choice. As in, you don't have enough money to even pick the right option.
Well, then you shouldn't be.
You probably shouldn't be doing it in the first place.
Shouldn't be spending money you don't have.
Yeah, exactly. I think people underestimate how much companies cost to set up properly, let alone run properly. You know, the amount of people who've come to me having already set up a company, haven't done a bad job, you know, they've kept share capital to a minimum and stuff like that. And then they're like, it costs how much to get your accounts prepared? Well, yeah, exactly. But, you know, at the end of the day, you probably should check this before you set up a business.
Well, that's another thing. A lot of people have lifestyle businesses, which is nothing wrong with it. It's fun. I say it's the majority of businesses in the UK because they're all tiny anyways. But a lot of people, when they set their companies up, treat their business bank account like their personal bank account. And this isn't like, I'm not trying to use a cliche line here, but they'll go and buy a car and they'll think, that's okay, it's a company vehicle. A Lamborghini Urus is not a business vehicle in the UK.
And it can be. It's just that the benefit in kind is off the scale.
Yeah. So that's the point, is like a lot of people kind of go, oh, well, I'll put the car finance payment on that. I'll expense this mileage. I'll expense that trip. I'll expense these clothes because I'm an influencer, all of that. And then they get, the funny thing is yes, you'll survive 2 or 3 years and you might survive forever if you don't get audited. But God forbid the day comes where you do get audited or you piss somebody off and they report you. You owe a lot of money. And I'm telling you this because I've seen this from companies, is they mix credit card debt with personal expenses with business expenses. They buy stuff on the business. They don't record things. They put in random amounts on expense claims. Again, you can get away with it. It's not worth the risk.
I think, you know, some of those things potentially could be, you know, expensible. And then there's other stuff that's clearly director's loan. But I think the biggest problem with, you know, using it like your personal bank account is not knowing, you're muddying the waters and you don't know how well the business is doing sometimes if you muddy it with all these personal transactions. It's a lot easier to make decisions based on the financials if you have a clean set of books and you know this P&L is genuinely all business expenditure. I know that's my real EBITDA, you know, and keep your personal stuff much more separate. You know, that's the biggest problem I see with that stuff, because, you know, you can allocate that all to director's loan and it's not really a problem if it's all personal. But yeah, we've seen...
You can allocate that to your director's loan, but then, as you said, you don't have a representative picture of the business, and then you do owe money that you can't afford to pay. You see a lot of businesses, especially in this online coaching space, consulting space, training courses, influencers. These people live lifestyles reams above what they're being paid. And, you know, the first issue there is they haven't got a business that's saleable. So they haven't really, you know, they've got no value beyond the cash flow, but they're spending all the cash flow and they're expensing things that probably aren't allowable.
Yeah.
And when you add all of this up, actually, you're just having a lifestyle here in a business that's here. And that's why you see a lot of these people on Companies House or on LinkedIn or whatever, they change their business every 2 years because they come to that realization the gravy train's run out.
Yeah, it's a good point you're making, actually, because, you know, sometimes the cash you see sitting in your bank account, you think, oh, there we go, I've got a good amount of money there. I'm going to go and spend it on whatever, the Lamborghini Urus, for example. But just because you've got that money there doesn't mean you can legally take it out as a dividend, for example, as well. So there's a big difference between what we call distributable reserves, which is the accumulation of profit after tax, less any dividends you've taken, vis cash in the actual bank account. You might not be able to legally take it out.
Well, and the government's getting wiser to it. What's the new HMRC thing where what's the tool they use to assess your spend versus what you've been claiming on them? They've started looking at people's social medias.
Oh, yeah. I know they're tracking that now.
Yeah. It's a tool they're using, that's a software, to outline discrepancies.
Okay. Not aware of that one, but I know they're tracking more and more online platforms. More just coming into scope. You know, they started with Shopify and things like someone where everyone makes their own stuff and they sell it on
Etsy or something.
Things like Etsy, things like people who've got properties on Airbnb. They started bringing all these into scope, so more and more platforms will end up.
Yeah, but if more people run their businesses legitimately, then there'd be a lot less money floating around, I think is a core insight. And then one thing I've seen a lot of recently that we've been on together is a lot of companies think having HMRC debt is just normal. Like I've actually had a business that you don't know of reach out to me and go, I'm looking at selling this. Do you know anyone who'd be interested in buying it? Can you help me a bit? You know, I don't do that, but I was like, I'll have a look. And he goes, is there any debt in the business? He goes, no, there's no debt. You know, there's a bit of VAT stuff there, but that's normal. I'm like, in what world is it normal to not pay your VAT? You collect VAT, you therefore must have it. Like it's not a magic number that comes from nowhere.
And it's one of those debts that's a real red flag indicator for lenders. You know, if you want to get debt from the bank, if you want to sell the business, it's often a red flag that it's not being run very well. Even if it's actually been used as a loan. I'm not saying it's a good thing. I'm just saying even if it's only been used for that purpose and people have used it as like a cheap finance option, it's a red flag for lenders. It's a red flag for investors. And, you know, you're taking risks, basically.
I mean, debt is good. Put it this way, debt is a very powerful tool if used correctly.
Absolutely.
But unfortunately, in the UK, for small business owners with limited track record, it doesn't exist at a decent rate.
Yeah.
It doesn't exist.
Yeah, unless you've got property or assets that are hard, easy.
You have to have proven track record in that sector, though. So in the US, you could be an Uber driver, get an SBA loan, 90% loan to value. I think it's up to $5 million US. And again, you could be an Uber driver and go, I want to buy a landscaping business. I want to buy a franchise hair salon, tanning salon, nail salon, whatever it is, right? They'll give it to you. In the UK, I've run a successful landscaping business for 4 years. I want to make an acquisition. It's £2 million. No.
Yeah.
Too risky.
I agree. And even if you've got an amazing track record, that's sometimes not enough. We've actually had it time and time again with clients where the bank said, you know, we can see that you've been working in the industry for 20 plus years and you've clearly got the experience, everything. We want you to have an FD, even though you've only got like 3 million of revenue. It's like, what? So now I've got to hire like 150K plus salary person. And it's like, that's like 5% of my revenue. You kidding? Or, you know, in some cases we've seen, you know, the banks have real problem with deferred consideration. You know, they basically want to see you pay the sellers up front, the whole thing, so that they can control cash flows going forward, which then means you can't incentivize the sellers.
Just how businesses are purchased.
Yeah.
Even the biggest ones, it's not a cash purchase. They're generally financed, seller financing, or there's some long-term payout that's bloody mental.
Exactly. So it's real shame that the risk and the way that lenders look at risk in this country has really gone down the pan. It seems like the second-tier lenders are cleaning up as a result, but at a huge cost to the sort of British business. I mean, we're looking at, for some of our clients, acquisition finance might be anywhere between 11% all the way up to 25%, which is kind of insane, depending on what margins you've got.
What?
Yeah, it could be even worse, in fact. Like we've seen some where there's like an equity kicker for no reason, really. You know, they even want the change in value to include all the organic that a business might achieve on their own.
Yeah, well, it's a lender's market then, I guess.
Yeah, when you set up a debt fund.
Why not? Stick some American capital into the UK. And I've been thinking of doing that, actually. I had a meeting on Monday about that. That's a story for another day. So in terms of, you know, let's pretend a business owner's listening right now and they've got a UK limited company, they're doing okay, they've got a pension, they've got a local accountant. So is there anything they should be asking themselves in terms of, again, their tax situation, their residency? What would you prompt them to think about?
One thing I would say is, okay, and I'm sure I'm doing myself out of a job to some degree here, but the amount of times I do a web inquiry with someone who says, look, my accountant doesn't tell me how to save here and save there, whatever it is. And I often say to them, have you asked them? And they're like, no. Why would I ask my accountant for an additional advice? I already pay them for the basic compliance stuff. And I'm like, well, if you never ask them for the advice, they're probably busy doing compliance for someone else, like in the portfolio of things. You want them to be proactive, but you're not sort of asking them, you know, and this is doing myself out of job, like I said, but you should ask your accountant, is there more I can do? Am I doing things as well as I could be doing it? And see what they say. If they say, yeah, I think so, or, you know, I'm not sure there's much else, then yeah, get in touch. But, you know, it's definitely a good first step because you've already got a relationship there.
Ask for help. Be specific about what you're looking for.
Yeah.
Assume that they're not mind readers. They're not in your business every day. Don't be cheap. Very importantly, don't be cheap.
Exactly. There's a lot of accountants there who are probably more than capable of helping their business, you know, the businesses in their client portfolio, but they never get asked to do more than the basic compliance. And then their clients are like, oh, and he never gives me this free advice. It's like, what, for free?
Yeah, well, if your relationship with your accountant is you shove a load of receipts at them 5 days before the VAT payment's due, it's not
Yeah.
You're not running a business then.
No, exactly. And it's not uncommon to have some lastminute.com clients. You know, there'll always be an element of that. But the lastminute.com clients, whether you're talking about doing it for tax returns or whether you're doing it for businesses or whatever it is, it gives us as accountants like no time to give you, are you sure you want to do that? Because actually you'd save a load of money if you did X, Y, Z. And the amount of conversations I've had like that where I would say, well, you should have done blah, 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 because you would have saved about 100 grand. And then they're like, oh my goodness, yeah, you're right. Well, we should do that next tax year. Yeah, we'll do that next tax year. Guess what? They always come in last minute, so you never get that chance to do it.
It's a shame. Leaving lots of money on the table.
Loads.
Through those things. So, yeah, I mean, I guess I was hoping for a silver bullet here, to be honest, Edmund, in terms of the tax structures and things. I guess the simple advice is make sure your account's up to date. Don't treat your business like it's your personal bank account. Have a pension. You can backdate your pension by a few years. I think 3 years in the UK. Residency is very different from where your business jurisdiction is. They're two very, very different rules. But there isn't really necessarily a silver bullet where I have a large business here. I'm in for a huge capital gain event. I'm selling in the next year. If you set nothing up, besides rolling it maybe into an investment, there's not really much, right?
Yeah, look, when you're talking to a firm that does proper tax advice, they do everything bespoke. And they've got probably like 10, 20 plus solutions at their disposal, and they might blend those solutions according to whatever thing that they've seen in front of them. You know, it could be any number of things. We've got an IFA in-house as well, who is also a tax advisor, and that is an awesome sort of thing to be able to lean on. You've just mentioned pensions, for example. You know, there are more options than just defined contribution. It's too complicated to go into right now.
Yeah.
But it does enable people who have cash lump sums to do a lot more than what they're currently doing.
So it's very bespoke.
It's always bespoke.
It's always bespoke, but there isn't, what I'm saying is there isn't some weird structure you can make for your big business that can just get rid of all the taxes.
I'm sure there's some silver bullets. We're still yet to find them. All the firms I've worked for, they've always had a big tax advisory arm, and it's always been a bank of solutions you've got to blend. So unfortunately not. I suppose step one is having a chat.
Yeah. It's not simple then, is what we're saying.
But
it's worth exploring because it can save you a lot of money.
It's never simple, and the answer is always, it depends.
Well, it depends is a great consultant answer, but there's a great phrase, business is simple but not easy. And that really describes this. You know, it's very simple to learn the frameworks, to know how to make a business profitable, but it's very difficult to execute often, and there's a lot of complexity riddled in there, and there's all these outside elements that come in. So business is simple but not easy for a reason, which is why I think you need the right advisors around you. I'm not going to use the word mentor because it's going to give me shivers, but the right advisors. Don't be cheap.
Yeah.
Don't leave things too late. I also think getting a second opinion is really important, because what makes your lawyer or your accountant or whoever you're taking advice, or your personal trainer, every couple of years you should get your things audited and checked, because you might be in trouble.
I don't even think, I mean, it's interesting you say second opinion. We've seen a lot more second opinions coming through recently, especially with AI.
So that's a whole other topic to go into.
Yeah, I mean, I don't want to go into it too much, but you know, the amount of people who are saying, oh, this is what ChatGPT told me. And I was like, yeah, but that's wrong for these like 5 reasons. Yeah. And they're like, okay, well, I'm glad that you've told me why, and I'm glad I came to you with this initial thing, because I've been ruminating on this, and now you've told me why not. And I'm not that bothered if people come to us with an AI, you know, summary of what, you know, ChatGPT thinks is the right answer. Normally, it's often wrong because it hasn't thought about, you know, loads of things, but that's not a terrible second opinion. If you want to kind of start off somewhere, you don't necessarily need to go to an accountant twice or 2 different ones. I think sometimes that can rub people up the wrong way.
No, it can. I just think getting something checked and asking lots of questions and investing time in it is very important.
Definitely make sure you understand it.
Yeah, you don't go to one Audi garage to get a quote for a Q5. You go to Nationwide Search and see what the options are. And again, it shouldn't be a cost-based thing necessarily with accountants. Again, you don't want to be spending more than a certain percentage of your revenue, but you do need to ask the right questions too.
Yeah, I think you need to ask yourself really serious questions when you're looking at a Q5 that's 60k and one that's £1,000, and thinking, why is it that cheap? doesn't necessarily mean it's going to work when you put the key in and turn on the ignition. So there's that analogy with advisors as well. You've said it already. Don't go cheap. We've seen some really interesting stuff out in the market that is questionable, and we've reported a number of instances that are kind of, you know,
absolutely,
almost dangerous to be operating. And in fact, we've we're working on something right now, aren't we? But we won't go into that. Yeah, you really need to make sure you get the right advisors around you.
Yeah, definitely. Well, look, Edmund, I think this has been a great conversation.
Yeah, it's been fantastic.
On all things structuring your business, getting the right accounting advice. I guess the thing here is that there isn't necessarily a silver bullet, but there is a specific solution for your company. And it's going to be a hodgepodge mix of a lot of different things. But that is generally the way. It's like if you're booking a flight somewhere and you need to get it under a certain cost, you might have to stop 3 or 4 times and change airlines. But if that's what we need to do in order to get tax down, and you're willing to make compromises that so-and-so isn't, then that's how it is.
It's tailored to you and your situation. And what we need to do is understand your business and where you want to end up.
Awesome. Well, looking forward to chatting again soon.
Brilliant. See you next time.